Hi guys, it's Maynard and Mike and Matt and Colin, and we've got two fantastic guests this Tuesday. We've got Neil Anderson, he's the president of Wood Mackenzie, and then we've got Randall Collum, and he's a managing director at Genscape. And these two guys are going to tell us a ton about what's happening in the world. So we're so happy you guys. Welcome Neil and welcome Randall.
Hey, great to be here, Maynard.
Fantastic.
Thank you, Maynard.
All right, let's get this thing going today, Mike. OPEC Plus, equity values, debt trading levels, the whole complex. We're at $39 here-ish. Talk to us. What's happening?
Yeah, I mean, I think the over the weekend, the OPEC Plus meeting went pretty much as expected. Most people expect them to roll over their cuts for another month. They did that. They also put a mechanism in to try to go after some of these cheaters, whether that's successful or not, who knows. But I think the big message that came out of there was solidarity and Russia and Saudi being in control. And so crude oil's traded off a little bit on that. Recently, competitor put a negative report out on crude oil. It's one of the things that we've been talking about that, crude oil, it's not going to be straight up and to the right. It's gone up straight up to the right here over the last 4 or 5 weeks, but we think there's going to be a little bit of consolidation. One of the things the market's looking at right now is, market's worried about Libya volumes coming back on. They're worried about U.S. curtailments unwinding. And they're also worried about refining margins are just terrible. And so you're going to need that backdrop to really to keep crude going from here. So we've always said that, crude oil was a 40 to 45 commodity this year. We're around $40. We think it's probably going to be in this range for a little bit of while. You're going to have to see demand really come back. It's not really accelerating as quickly as we would like at this point in time. Like we said for the last couple of weeks, getting the first 10 million barrels back was easy. Getting the next 5 or 6 million barrels is not going to be as easy. And that's kind of the stage we're in right now. So the market's kind of just fluttering around from an oil standpoint. Don't really see anybody making really any big negative bets or any positive bets. I think, at least the guys I talk on the commodity side, they're pretty neutral at this point in time.
So Mike, when you make those comments, I guess I'm struck by, Colin's going to get to this, those are informed energy comments, right? Those are people who really watch energy. There's obviously a lot happening in the market right now, which is just flows and sentiment and so on and so forth. So can you unpack that a little bit? What's really driving the energy market right now? Is it energy people or is it others?
Well, Colin's going to talk a little bit more about this in a second, but I think the way I see it is, the move over the last couple months has been really fundamental based. Oil going from, $20 up to $40. And so that's why the stocks move. But over the last couple of weeks, it's been pretty much a euphoria. It's been money flows. It's been, momentum money shifting to value money. It's people basically seeing the jobs number on Friday saying, hey, you know what? Cyclicals is a place to be, and that's where no one was at. You're seeing momentum money. For example, the top three sectors in the S&P are about $14 trillion in market cap to the best performing sectors. The three worst performing sectors are about $6 million in market cap. That $14 million is going after that $6 million. So there's money flow going there. So that's what's going on at this point in time, is just a money flow issue. And who knows when that's going to stop. It's not fundamentally based. It's just a money flow issue. And guess what? That can turn on a dime. Look at today. We're seeing a lot of names that are down 8, 9, 10, some names down 20, 25%. And I think this volatility is keeping a lot of generalist money away. And it's also, what it's done is a lot of the guys on the short side have been playing quality versus non-quality names. They've gotten really hurt here over the last two to 3 weeks. And so they're breathing a sigh of relief today.
Colin, money flows. This has been your baby for the last few days. You can't stop talking about it. Tell us what you think.
Yeah, I think it's important to sort of review where the money flow came from. If you go back to March, obviously we had the disease. We went into the shutdowns and we had a lot of people lose personal income. To put a number on it, it was close to $400 billion on a seasonally adjusted annualized basis in the month of March, almost $2 trillion in the month of April. So what happens? We have Congress come in with the CARES Act. We have other unemployment insurances supplemented with special discretionary packages. And all of a sudden, there's $3 trillion on an annualized basis coming from the government. Okay, so if the economy were still operating in a normal fashion, people might have spent that on going out to dinner, going to the movies, doing whatever they're doing. Instead, what actually happened is personal income, disposable personal income for the country as a whole, went up $2.1 trillion in April, but consumer expenditures dropped by $1.9 trillion. So if you do that quick math, all of a sudden, in a society that has not done a particularly great job of saving, there's a $4 trillion pot of cash on an annualized basis that has to go somewhere. Now, if you're going to cut interest rates down to zero, it's not particularly attractive to go leave it as a demand deposit at the bank. And if you make it super easy to buy fractional shares of quality companies or even some distressed companies in the stock market, it is no surprise at all that people will pick out their phone, sit on their couch, and start trading shares. And what's really fascinating about some of the touch to our space in the E&P world is that there's been this appetite for the most distressed names. And actually, it makes a lot of sense because we've seen a platform like Robinhood, for example, target an E&P company or two to the tune of having daily volume 100% of the size of the market cap of those companies. And if you look at the short interest as a percentage of the float, two of the larger names have been in the 30 to 35% range. So it is absolutely clear, the punchline is that the retail investor has chased out the institutional investor and given us absolutely extraordinary moves to the tune of 50 or 60% daily spikes just in the past couple of days.
Wow. So is that what you're perceiving, Mike, that we've got institutions on the sideline and we've got smaller players in these energy stocks, or no?
Yeah, I mean, and Matt can talk to this in a second, but I mean, like our trade desk, we're not seeing a lot of generalist money coming in. We're not really seeing a lot of generalist money selling, but they're just not coming in because they're concerned about the volatility. The group's gone too much, and so I think they're there for a pullback. But they have not been buying into this rally at all. So it is definitely a retail rally.
So what do you think, Matt? How do you make sense of some of these moves? Which of them make sense and which of them don't?
Yeah, I think Mike and Colin hit it on the head in terms of sentiment as we've chatted with investors. And as we've talked over the last 2 weeks, we've noticed investors have been taking a pretty cautious stance into this rally. Generally chasing or investing in companies with good balance sheets that are paying dividends. That kind of shifted towards a more negative outlook on equities over the last 2 days. The desk has seen pretty significant kind of selling pressure on equities in the last 2 days, so into this kind of huge move up. And I think it just reflects investor confidence that equities are generally reflecting a pretty constructive crude price rally in the 2021 and 2022 timeframe. If you look at just upstream, for example, you're now pricing in $45 to $50 a barrel. And so stocks are fairly valued. And I think in this market, investors would like to see a healthy pullback to get more involved in the space. Generally speaking, probably looking for something close to 10 to 20% or affirming of crude fundamentals further from here to really kind of put more dollars to work.
It seems like when oil was 25 to 30, we were saying the stocks were pricing in 40. So now that oil is almost 40, we're saying it's pricing in 45 to 50. So they feel like similar bets. Does this market feel, why does this market feel overvalued or frothy relative to the previous one, or is that fair?
I think a lot of clients that we talk to, and this is the camp we're in, $40 long-term isn't sustainable. And so when equities got down to those valuation levels, we did see a huge uptick in value investors wanting to talk about the broader energy space as a whole. It just looked like a great buying opportunity. As you get back to 45 to 50, you're starting to kind of hone in on kind of what some of the clients we talk to think is fair value for long-term crude. We're a little more constructive than that. But I think a lot of investors that we've chatted with over the last few weeks do feel like there's the potential for crude to weaken here a little bit and the potential to find a better entry point in the equities. And so clients are just going to be patient, and I think they'll wait to pick their spots on the stocks and get involved when they feel more comfortable with the macro backdrop.
And Mike, you referenced it. Colin, you and I talked about it. There was a major firm out with a piece talking about weakness in oil from here. And, you know, we talked about that. What is the case for weakness? And then what's the case for we're sitting here in 3 weeks talking about $49 oil? How do you How do you think about those?
Well, I think
It's illuminated by whether you're talking about strip or you're talking about spot. And of course, all of these things are crucially dependent on what time frame you're talking about. So I'll give you an example. If you look at the year-to-date global U.S. liquids demand in the United States, it's down about 2.32 million barrels per day year over year. If you look at the production cuts that we've seen since the peak back in March, okay, people can have different views anywhere from 1.7 to 2.2 to even 2.3, but it's in the same zip code. And you're going to basically get a sense of this is a market moving to balance. If you look at the instantaneous present, though, you're going to get a number that's closer to a 2 million barrel surplus in the United States, even as the world is probably in a deficit right now. So put together all those pieces. Are you talking about the global balance or the domestic balance? Are you talking about discounting a price over 12 months or somebody who is literally in a basis market looking at the next 4 weeks with those refining margins that Mike was talking about? So the easy punchline to take away is there's this sort of simple, quick rocket back on those 10 million barrels that Mike talked about. And then real uncertainty about what happens over the next 12 or 24 months when we don't even know how many of these restaurants and enterprises are going to come back, what second shoe drops in terms of economic activity, what happens when the CARES Act rolls over in August. Do we have some kind of slump here in the middle part of the year? These are all debatable points. And so it's rational for an investor to basically say, I kind of know where I got to now, and I really don't know what happens next, but I'm starting to get a little nervous about some of these valuations.
Isn't the money flow argument you were just making, Colin, and we've got a valuation point we're making here, we've got a money flow point we're making. When the valuation gets too frothy, the flow goes somewhere else. This was your point. This was Mike's point. We had 14 trillion in 6 sectors, went to 6 trillion.
14 in 3 sectors: the
14 and
healthcare, tech, and basically consumer discretionary. 3 worst performing sectors are industrials, financials, and energy. It only makes up 6 trillion. So you have 14 chasing 6 trillion because there is money moving in that direction. Yeah.
So I guess that's my question. If the money flow starts to think energy is now, we need to hit pause, where does it go from here?
So the way that I think about it is,
Colin, you can't say Massachusetts real estate.
I've got a house to sell if anybody wants to buy it. If you look at April 21st, right, you saw a lot of would-be retail value buyers come in when crude had a single-digit price, and they thought, well, what could go wrong? This is a home run. And the danger in putting this capital to work in equities is the day trader suddenly becomes a 2 or 3 day trader and doesn't realize that, to Matt's point, you bought at 50 cents. Yes, it went to $2, rang the bell, and now it's 0. And you have no hope of getting your money back ever because it's going to go to the bondholders first. So I think there's a real risk here that the Fed and the governments of the world, central banks of the world, write a lot of checks. A lot of capital gets invented out of thin air. It gets deployed to retail channels and institutional channels, and people get a little bit too frothy at these prices. And so what then happens is it just goes away. And now you wake up in August or September and the cafe is closed and the servers don't have a job and CARES is winding down and unemployment insurance has been exhausted. And now there's a moment of, well, what now? Do we invent more money? Do we whip it out of thin air? And if I play this game again, do I buy hard assets? Do I buy paper assets? So reasonable people can have different views about this, but history tells us that fiat money can just cease to exist. It'll just go away. It doesn't go anywhere.
I'd say 2 things. You're dealing with a lot of quant money that doesn't care about valuation. It cares about momentum. And so that's one thing. And the other thing that's going on right now is that the generalists out there do care about valuation, but the retail investor cares nothing about valuation. He's trying to pick up anything under $5, and that's the case. So that's what's going on at this point in time. And like I said, a week from now, 2 weeks from now, these things could be down 25, 30% and have nothing to do with valuation. It's just a money flow issue.
I'm realizing we're going to have to do this show on Thanksgiving Day because this is starting to feel like a good family argument. Let's get to our guest, Neil Anderson and Randall Collum. Neil, it is so exciting to have you guys here. Neil is the president of WoodMac. I think where we wanted to start, Neil, is just get you to describe WoodMac in terms of numbers and strategy and the things that you guys are in, because even though all of us know WoodMac, I'm not sure we know the 2020 version. And it'd just be great to hear from you all the things that you're doing.
Yeah, perfect. And listen, it's a pleasure to be with you folks and enjoying the conversation. WoodMac, just like yourselves, have gone through a huge transformation over the last 4 or 5 years. We've always been known to be in the energy side. Our history 47 years ago was starting in the upstream piece. We've since evolved right across the value chain, and we've gone global. So you've got 1,600 folks in 39 offices, covering everything from lower 48 tight oil, the whole way through to electric vehicles penetration in places like China. And the really big focus of Wood Mackenzie over the last year or two then is helping our customers navigate the energy transition. So we've had a big focus getting into mining and metals because of things like copper, lithium, cobalt, nickel, and also into the power and renewables business. And that's really where we see the future of Wood Mackenzie, Maynard.
So Neil, as you get to, I have this image of you, sitting in WoodMac air traffic control, and people are reporting in from all over the globe. What trends or topics or questions or requests for help do you get that are surprising or interesting or different? What would you say what are the flavors of the month right now?
Yeah, Maynard, I lived in Houston for 14 years, and I moved to the UK August 2018. And prior to that time, even though I've got an upstream background, geologist by background, I would talk about the energy transition to the US clients. And I really wouldn't get much traction. Moving them back to Europe, it was light and day in terms of what the European majors wanted to talk about. And indeed, that has spread over to the Middle East and indeed spread over to Asia. So the number one focus of those folks is all around the energy transition. And it's not that it's way out there, it's happening today, but it's all about acceleration of that energy transition and how they position themselves to really make a success out of that. That is the number one thing that folks talk about, Maynard.
And when you say energy transition, I think the old definition used to be, when are we going to wind and solar? The new definition seems to be, what are we going to do, period, that's cleaner, more efficient, more affordable. It's a much broader definition. I'm kind of putting words in your mouth, but is that how you see it, Neil?
It is, Maynard. This is something I personally find really frustrating. It's a very polarized debate. And we have that exact same debate in Wood Mackenzie because we've got a really big solar, wind, smart grid storage business now at WoodMac. And people seem to think that green energy is the answer for energy transition. And really what I'm talking about here is decarbonizing the energy mix. And what I know of the energy transition, it's such a big global challenge. There's not just one solution that's going to help us with this. We all have a role to play in this. And indeed, the upstream oil and gas companies have a huge role to play in this. If you look at forecasts, be it Wood Mackenzie's or the IEA, and you go out to 2040, fossil fuels still make up the majority of the energy mix. Even within the IEA Sustainable Development Scenario, it's something like 65%. But the key thing there is you're swapping out coal for natural gas. And the other key thing is you need to do something with the carbon. And that's something that I personally think the major oil companies have got a real role to play. They understand how to separate gases and liquids. They understand how to store gases in reservoirs, and they've got the R&D dollars and expertise to make it happen. So we at Wood Mackenzie take a much more holistic view of the whole energy transition.
I know one thing it came up a little in the pregame is that you guys look a lot at hydrogen, for instance, and what could happen there, things like that. I think we all sort of have a sneaking suspicion that in 10 or 15 years we're doing things that we're not talking about now.
Yeah, I think it may well be sooner than that, but I think two of the big technologies that we do need to talk about are CCUS and also hydrogen. And I think blue hydrogen makes a heck of a lot of sense for this industry because of the existing infrastructure and expertise. And that's something that I think all of us should be taking seriously because it's going to be one of the key solutions in terms of how we do decarbonize the energy mix.
Matt, I know you've been thinking quite a lot about these issues and how TPH research begins to focus on some of these topics. Anything you would share with our viewers about that and how you're thinking?
Yeah, I think Neil's view of the world is very much a view that is held by clients we talk to on the investment side. We've seen a shift in portfolio allocation to be a bit more balanced and taking a longer term view of what energy really means. And as we see our clients moving in that direction, you'll also see TPH research moving that direction as well. So we're quite excited about it. It sounds like Neil and his team are well along the way in understanding that market dynamic, and we hope to participate in that as well. But we definitely do see investors across both the US, Canada, and Europe really digging into this topic, and it's becoming extremely relevant to energy conversations over the next few years.
I mean, it honestly seems like whether you're a consultant, an investment bank, a researcher, or a major industrial player or producer, what you've got to get right is oil and gas is going to be a huge part of the equation. Keep your eye on that. At the same time, you're keeping your eye on everything new. And that's really the challenge and the focus. Neil, does that feel right to you?
It does, Maynard. And I think something as well, I mentioned earlier that the energy transition isn't way out there. It's happening today. And if you look at some of those European majors, they are fundamentally changing their business model. And the old traditional E&P approach, the exploration side, is essentially dying a death. They're not spending risk dollars in exploration. And they're looking at their upstream business and they're almost using it as a cash cow to fund everything else. And you're seeing that with a lot of the European majors. And I think that is something that, again, here in the US, when you really need to think about, does that fundamentally change our business?
So Neil, how does that kind of change, since these guys are really starting to transition quickly, how does that affect your modeling, in 25, 30, just from an oil and gas standpoint? I mean, are you guys more bullish on oil prices because the transition's going a little quicker for those guys, or how do you feel about that?
Yeah, we've always predicted that there's going to be peak oil demand around the mid-30s, 32, 33, 34. And that's why things like we've got really a big time into petrochemicals, because we think that's going to be the key driver for oil demand beyond that. But there's lots of unknowns, obviously, ahead of all of that in terms of this pandemic. And again, this is a debate that's happening in Europe at the minute. What will the world look like post the pandemic? And there's lots of questions about, retreat of globalization, localization, supply chains. But to me, a more intriguing one is the role of government. Because I think certainly in some European jurisdictions, there's going to be way more openness, maybe somewhere like Germany, where the government has done really, really well in managing the pandemic, more openness for the government to get actively involved in the economy. The stimulus dollars that Colin was referred to in Europe, does that be aimed towards green energy? Does that accelerate the energy transition? So there's lots of things here that I think are up in the air. So yes, our house view is mid-30s, but there's lots of things that could change and change very, very, very quickly.
Do you feel, Neil, in your business clients, who look at the globe as a bit of a menu, gravitating their interest to places where they feel like there will be less regulation? Like, I think obviously one of the big issues in the US election is around what does a Biden administration, how do they treat oil and gas? That's a big issue. But do you see what's that?
Absolutely huge issue, Maynard, yeah.
So do you see your clients kind of asking questions based on how they perceive jurisdictions to be changing and which places are more oil and gas friendly and which are less?
I think there's two. So the private companies, yes. The public listed companies, no. Because the way they look at it, it's almost like akin to a license to operate. They have to be seen, and again, maybe this is very much a European perspective, they have to be seen to be driving and accelerating the energy transition, regardless of where they want to move their operations to lighter regulation. Because they are quoted globally, and they have to be seen to move on this. And I honestly think the same thing will happen, particularly to the majors in the US. as people become more aware of this.
All right, I got to get my buddy Randall in here. Randall, you guys do so much of the data. I know I was asking Mike a few weeks ago, how do people develop the basis on which they have an expectation? And he said Genscape. So I think so many people know Genscape, but could I ask you for 90 seconds, just for those who are less familiar, about what you guys do, what you focus on, how you help your customers?
Yeah, thanks a lot, guys. Appreciate it. So I think I mentioned it to you this in the pre-call. We've been called by the Wall Street Journal as like the CIA of the energy industry before Wood Mackenzie purchased us. And so we like to spy on stuff. We come up with proprietary views of what's flowing on oil pipelines. We track daily oil production. We track daily gas production. We're tracking storage. We have flyovers of storage at Cushing and can estimate how much Cushing storage is changing every week before the EIA reports it. So we're getting into a lot of that, but we've also taken that proprietary data and done forecasting off of it. So whereas when we're forecasting oil or gas production, having that real-time tracking of production makes us that much better forecasting because we can see things before it gets reported by the government or the state.
So Randall, this we've had this unprecedented, shut down the U.S. economy, shut down the global oil and gas production machine, and then we're starting to turn it back on. I mean, this has been incredible. How has your ability to analyze this market held up with so many moving pieces? Has it, all of that data you're collecting, has it been right? What have you had to modify in terms of how you watch the market?
So one thing I'll go back to when we're looking at that, when we're trying to do our forecasts or whatever, is rig counts. When we're looking at the oil and gas production side of things, in April, we saw 4 different weeks where rigs dropped between 9 and 14% week on week. Huge changes. In my 20 years of doing this and looking at all this data and analytics, the biggest week on week drop we'd ever seen was in December of 2008 in the middle of the financial crisis, and it was like 8%. So it kind of blew out a lot of our historical models as far as how quickly the rigs dropped. And so we had to make kind of real-time adjustments on the fly. And that's what we do. We are the short-term side of things. So we're looking at things on a weekly basis. We're putting out forecasts every week. We're putting out daily production estimates every day. So we had to make quick adjustments for how those rigs were coming in. Then we had to go in and look at things like the shut-ins and the deferrals of wells that producers said, hey, listen, this market environment, some producers, the day it hit negative WTI prices, they said, we're shutting it in tomorrow. That's it. We're not dealing with this. So being able to react to that and seeing it in our data, just honestly, it was a fascinating time. I've been doing this, like I said, almost 20 years, and I haven't had so much fun. I mean, I'm a managing director, I guess, but I'm an analyst at heart, and I've loved every minute of it because it's been fun.
You heard our guys talking about these markets and where prices are, stocks and oil price. Do you agree with the sentiment that the 20 to 40 run felt a little more perhaps obvious that it would happen and less clear from here? Or what is, you're looking at the data, but what, are you surprised we're here? Does this market feel like it's getting ahead of itself to you?
If you had asked me 2 months ago, I would have told you I don't think we would recover that quickly. But I also wouldn't have predicted that we would have shut in 1.7 million barrels a day in May. I mean, the producers came out and made a concerted effort to really, I guess, quote unquote, impact this market and make sure that they were here for the longer run. And I think, honestly, they should be proud of themselves for actually doing that instead of just produce. We saw some producers who came out and said, hey, listen, we're shutting in our wells that are uneconomic. We've seen other producers like ExxonMobil come out and say, hey, we're just going to shut in our biggest producer wells. Who cares about economics? We're going to shut in the ones that we can turn back online the quickest. So I'm more surprised at the fact that the producers actually reacted as quickly as they did, and it actually helped the market, and I think it'll help their longer term survival. Now the question is, how long will they stay shut in? How long will they defer these wells? Because the quicker they bring those wells online, maybe drives down oil prices somewhat. So I think there's a very tight balancing act they have to follow over the next several weeks, just really to see how this market plays out.
Randall, maybe a follow-up question there. One of the key things investors are focused on right now is the pace and cadence of production returning in June and July. Just given all the data you have access to, what are you guys seeing in terms of a real-time discussion around crude flows and gas flows that might indicate directionally where crude production is headed in the U.S.? And then I guess the follow-up to that question would just be, how long do you think it does take to fully reverse curtailments in the U.S., and what are your expectations over the next few months?
All right, appreciate the question. So, Genscape Wood Mackenzie, we actually believe that U.S. oil production peaked around 12.8 million barrels a day in March on average. We've seen recent prints as low as 10 million barrels a day. With the way the prices rebounded, we expected production to start bouncing it back up here in June, and we actually have started to see the initial fruits of that. Of course, it's going to take longer to turn the wells back online as opposed to what it was really to shut them in. We saw a big drop on May 1st, but right now we're just starting to see it kind of slowly trickle in the data we track. Like I said, we are tracking oil pipelines. We are tracking rail tracking out of, or we're tracking the rail cars out of the Permian and the Bakken and using that to come up with our daily estimates. The main areas where we've actually seen a recovery in production so far has been the Eagle Ford. About 200,000 barrels a day is recovered already there. We started to see the Gulf of Mexico recover actually last week. We saw about 200,000 barrels a day added there, and then the storm hit, and we shut in 700,000 barrels a day. So over the next few days, we actually expect to see probably another 500,000 to 1 million barrels a day added as the crews get back up to the offshore platforms and such and get those wells back online. That being said, we kind of bottomed out around a 10 million barrel a day level, like I said, from our peak at 12.8. We're expecting to get back to probably around an 11 million barrel a day daily kind of production level by the end of July. And then from then on out, it highly depends on when these DUCs actually get completed. I think it was Parsley who came out last week and said, hey, we're expecting to start probably completing some of these DUCs later this year in the current pricing environment. I mean, as of Friday pricing, we were at a $40 12-month strip. That suggests they should go do that. Right now, we're actually calling for about an 11 million barrel a day average for 2021 on production. We think we'll decline probably through the end of the year, get down to a lower level around 10.5, 10.6. But the current prices actually should incentivize rigs to start coming back online early next year, probably. We're expecting rigs in the U.S. to bottom out at around a 200 rig level around August, September time period. And we think you could be backed up to 450 or so by the end of next year.
Randall, one question for you. I know you watch natural gas in particular quite a lot. What are you seeing in that market? Because there's been quite a lot of talk about early on in all this about how natural gas could have a great run here. Some of the companies have done really well, and then there's a lot of bullish forecasts for next year in natural gas. What are you thinking on gas?
So I will say this. I think almost every single one of our clients is bullish on 2021. The problem is we got to get 2020 out of the way first. So peak gas production hit in November.
Did Matt Portillo give you that line? Because that's his favorite line.
Is it? No, he didn't.
He says it all the time.
Nice. No, so we think production peaked out in November, actually, of 2019, around 95 BCF a day, and was already kind of starting to turn over before all this oil crisis hit. We averaged around 93 BCF a day or so in March. We've actually touched the 84 BCF a day levels in May. We are back on the way up. I think today we're around 86.5 BCF a day, and Gulf of Mexico is recovering. We'll probably get another BCF a day back as the storm, erodes and gets all the crews back out to the platforms, like I said, on the oil side. That being said, we think it will fully recover on the gas side, probably around 90 BCF a day by the end of July. Probably going a slight decline for the rest of the year, and then should be relatively flat at current prices right now. But here's the issue. when we do our forecasts, we look at everything based on the current market. So we're looking at the forward supply or forward pricing, WTI, forward regional gas prices, and we're running those through our models and coming up with our production estimates based on economics, what rigs will run in each region. And right now, based on those forward prices, our S&D view is that we'll end October around 4.1 TCF in the ground. For, I think, March, we're around a TCF in the ground after a normal 30-year kind of winter is what we look at it. The problem becomes later in 2021 when we're exiting October 2021, somewhere around like 1.5 TCF, which is very, very bullish because most market participants want to see about a 4 TCF level going into winter. And so the issue is, how do we increase demand and increase production to get to that demand that we're seeing? And you're going to have a higher price. And that's what everybody is seeing. Pretty much everyone in the market that we deal with, and we mainly deal with traders on the Genscape side, they're all pretty bulled up for 2021.
So I have a question for both Neil and Randall. You mentioned the storm that's in the Gulf, and in some ways, everything we've been dealing with from an economic perspective is a economic storm or a financial storm. And earlier this week, we had the official arbiters of U.S. recessions tell us we're in a recession. Like, no kidding, we all know that. When we look out into the next 6 months, what would be your advice to our viewers on how to think about this particular macro environment and where it touches their businesses? Like, is there a real risk here of getting those rigs back in place, getting that 450 number, and that is actually what kills the golden goose? How do you think about that? Maybe I'll go to Neil first.
Michael or Colin, I wish you had gone to Randall first. I'll answer that from a macro view, okay? The best way I've heard the pandemic described is in 3 phases. So the first phase, and this is a global view, lockdown till whenever, around the end of this month. Then a transition phase, which who knows how long that's last, but let's say the end of the year. And then everyone's using the overused terminology, the new normal from 2021 onwards. That transition phase, where places like Asia are certainly in the midst of parts of mainland Europe and certainly parts of the state, that to me feels very, very much like whack-a-mole territory. And what I mean by that is we will get flare-ups of cases and we will have to go into lockdown. Hopefully it's much more localized rather than shutting down an entire country. But that is just going to throw everything up in the air, because the really, really, really unknown in all of this is people's mentality about how they feel about the virus and how they feel about the risk exposure to the virus. And my big fear is, as we start to come out of lockdown, if we get big material flare-ups, that could really knock customer sentiment. And we really could have a major recession on our hands. Again, that's from the macro side, Colin.
And Randall, what are your thoughts?
So, yeah, I think it's going to be highly dependent on how this kind of economy does over the next several months, because part of that is if the economy does come back strong, we don't get that second wave or what have you. How many of those rig workers go find jobs in other industries? Can they get back out to those rigs? Like, how hard will it be to find a rig crew? Right now, like I said, we don't really have the rigs bouncing back up till 2021. We have it pretty subdued for the rest of this year. We actually have it declining through September and then pretty flat. But I think a lot of it just depends on how kind of the rest of the economy works. I mean, I'll tell you this for an example. In 2006, when I worked in Wyoming for a certain producer, we tried to go add 3 rigs to our basin, which it had been a while since we'd had any rigs there. And within 6 months, 90% of our rig crews actually failed drug tests. So it's going to be difficult to go find people to run those rig crews if they've gone and found other jobs and they remember what happened this year when we hit negative $30+ oil, and how they were out of a job, and if they found another job, then it might be hard to get those rigs to bounce back up, and that's the big issue, I think.
So, Colin, I'm thinking about closing with you, unless anybody else has anything else, which is to say, we had this jobs report last week, which was a big surprise to the upside. We've got a market that feels I mean, it is the stock market that is very strong. So it seems like our commentary, I'm thinking about what Neil said, with some of these recent data points, we're now starting to think, whoa, are we getting too bullish? Are we getting too rosy? We need to think about the downside a little more. Whereas previous 2-3 weeks, we've been calibrated just the opposite. It was so negative, we were saying, we have got to think about the upside more. So will you answer the question you just asked Randall and Neil, which is how should we think about this macro world over the next year? Has it got more upside in it or more downside?
Well, that's a great question.
Finally. I mean, give me 40 minutes. I'll come up with one.
At the risk of sounding Pollyanna-ish, in my heart of hearts, I really believe the future is not settled. There is still time for our better angels and our better decision makers and our smartness and our cleverness and our resilience to win. And I think that when you look out there, there's such a mood of fear and anxiety that is totally understandable and justified in so many ways. And yet, when you look at the question you're asking about the jobs report, are we really going to obsess over the technical definition of whether somebody was employed but at home instead of unemployed but temporarily laid off? I mean, it boggles the mind that we would even have that conversation. The fact of the matter is, millions and millions of people are out of work or are in a very precarious situation. We have the resources to fix this. We have the resources to be smart on how we deploy countermeasures to the people most at risk. And I'm thinking here, as we've said many times over the past few weeks, the aged, those who have other diseases that put them at elevated risk, to be smart about it, to let people go to work if they feel comfortable, not if they don't. That's the only rational thing to do. And when we look out into the future, I think Neil's point, this risk of a recession is very, very real. And that if you do this wrong, and if you don't take the downside seriously, you can get there faster than you would hope. So be smart. But at the same time, when you see, people, you hand people a lot of money and then they go day trade it a little bit, well, that's not, they're having some fun. It's a little bit of sport. And so it's really important for us, in markets who might tisk a little bit. And I certainly put myself in there, like, what are you doing day trading, some of these names, to maybe take a step back and say, let's keep an eye on the big picture, that we're trying to have this be an outcome that's great for everybody and to be rational and reasonable over the long run.
So I think what you're pointing to is we need to turn Genscape's brains and models and all their gadgets, they need to be tracking optimism, because we could all use a little bit more. Is that what I hear you saying, Colin?
Amen. And let's do it with helicopters and the flyovers.
Well, I want to thank you, Neil and Randall, for joining. Fantastic. We joked we're two companies separated at birth, so it's great to be back with you. Maybe we'll have you on the Thanksgiving show. But in all seriousness, thanks a lot. I'll end with this optimistic thought. I think in all the strife and tension and stress and pressure that the world has felt, I have noticed people on the street, people in the store, just, wherever you are, people being nicer to each other, because we all realize we got to take the temperature down a little bit. So that's Randall. Keep up with that optimism. There's some for you.
I like that. I like that a lot.
All right. Thanks so much, guys. And thanks, everybody.